Lots of changes in the tax code. All of that is starting to take effect, it looks like. And for the 2018 taxes that you're filing in 2019, you're going to have to be careful, and hopefully your accountant is on his game. Your CPA is on his or her game and knows exactly what the changes are. But have no fear. We are talking with Andrew Wagner right now with H&R Block. Andrew, thanks for being with us here on CCN Sunrise. Should people be worried about their taxes this year?
I don't know that you should be worried, but you should definitely be interested in the outcome. This is the first year that the Tax Cuts and Jobs Act takes effect. So all the 2018 was under the TCJA. So when you're filing your 2018 tax return, there are going to be a lot of changes. First off, the tax rates have dropped for many people. The standard deductions have increased for many people. There are no longer exemptions. If you're claiming dependents, you used to be able to get a $4,050 deduction for them. That's gone. If you have dependents under the age of 17, the child tax credit you can get for those dependents, it went from $1,000 last year up to $2,000 this year. And also, you were previously phased out of that credit if you were married and made under $130,000. Well, now you can get it if you make up to $400,000. So it's going to be accessible to a lot more people. All of these things just have a cumulative effect, and they're going to affect the outcome of your tax return for pretty much everybody.
Now, I have some friends who have been complaining this year because they have some really big, beautiful homes. And for some reason, they're not going to be expecting or getting the same kind of money or refund or something that they used to be able to get. What's that all about?
Yeah, so previously you could deduct interest on the value of a home up to $1 million. Well, now that's dropped to $750,000. So they can still deduct some interest, it's just phased out once the value of the home exceeds $750,000. Also, kind of along those lines, the standard deductions increasing have prevented a lot of people from itemizing. Now, if your friends have really expensive homes, they're probably not in this zone. But if you're a married couple filing joint, the standard deduction is $24,000. Last year it would have been around $12,400. So if your itemized deductions, including your mortgage interest and your real estate taxes, were about $17,000 last year, you could have itemized a year ago. Well, this year you wouldn't be able to itemize because your standard deduction exceeds that $17,000 at $24,000, which is the new rate or the new amount that it is this year.
Are there different ways that people can make up for it then, if that deduction is lower?
Well, it's not necessarily a bad thing that the standard deduction exceeds your itemized deductions because it's still tax-free income. It's just kind of a psychological barrier to say that you're not using your mortgage interest, but you still have more tax-free income if your standard deduction increases. And also the tax rates being a little bit lower is just a natural way of making up for some of that. So most people will see a drop in overall tax liability, but whether or not you actually get a refund is going to be more based off of your W-4, which is the form that's used to determine the amount of withholding for federal and state purposes from your employer. So if you planned all 12 months of the year and you've had enough withheld, you should be okay despite anything tax reform presents to you. But if you didn't plan the whole year and you had less withheld than you were supposed to, you got bigger paychecks throughout the year, but then you might wind up with a balance due on your tax return.
For the regular Joes, is it possible that some people may have to pay taxes for the first time? Like they won't get a refund and they'll actually have to pay?
Yeah, that's possible. It's really no different than any other year, though. You could have these surprises creeping up on you at any time. So if you had, if you didn't adjust your W-4 early in 2018 and your employer wasn't withholding enough, you were getting those larger paychecks, which is great because you had more money, during the months, during the weeks throughout the year. But then when it comes to tax time, it's time to reconcile everything, and you may not have had enough withheld. Now, tax reform also affected people who have employee business expenses. So these are people like truck drivers or someone who had to buy tools for work. You would have been able to deduct those in previous years if you itemize your deductions. Well, in this year, for the most part, those are all gone, unfortunately. So you wouldn't be able to deduct those this year. So if you're in that kind of group of people, you might have a little bit of a surprise when you can't deduct those any longer on your tax return.
Now, in these last few seconds, Andrew, I want to ask you, because we're taping this during the shutdown, the partial government shutdown, and there's a lot of fear from some people that they won't be able to get their refunds on time because of it.
Yeah, that's right. So if you're, naturally in previous years, if you have the earned income tax credit or the additional child tax credit. The IRS is holding on to returns that have refunds and have those two credits until mid to late February. So if you're in that situation, that's nothing new. The IRS has been holding on to those refunds for a couple of years now, but you have a couple of options. You can come into an H&R Block office and apply for a refund advance, and that's done with your tax return. And if you're approved for that, you could get up to $3,000 of your refund that day, and then the additional amounts, if you're getting a refund larger than that, would be funded to you once the IRS issues the refund. And so this is a no interest, no fee loan. It's offered through H&R Block, but it's sponsored by Axis Bank. And so that's a great option if you're a furloughed government employee, or if you just need your refund a little bit sooner. Come into an H&R Block office and apply for that refund advance.
Well, it sounds like there's some options for folks out there. Thank you so much, Andrew Wagner with H&R Block. I appreciate you taking the time this morning.
Yep, thank you for having me.